It's come in at 6.5%. So clearly 6.7%, which the Reserve Bank was anticipating, has not come to be, and it is 6.5%. Dr. Sen, you will have to just hold on because we are trying to get more numbers. The PIB website
GDP figure. So that again implies a 7% growth at least for the next 2 quarters, Latha. And the GVA is much lower. It's at 6.1% versus an estimated 6.5%. So the GVA is much lower. So the asking rate for the next 2 quarters would be much lower. I think it would be a sub
the
7%.
Average, exactly. The average for the first 2 quarters was 5.6 and 6.1. So the average was about 5.8. If you have to get to a 6.1 number, then something like a 6.6 or 6.7 is adequate. With that, Dr. Sen, we are flashing the numbers over here. If you can tell us, sir, very quickly, how good are these estimates, because they are extrapolated from only 7 months of data.
Not very good. When I was the chief statistician and later as the chairman of the National Statistical Commission, we had objected to the CSO bringing out the advance estimates, saying that it has the danger of coloring the actual figures when they do come out. We don't like the data generating agencies to make extrapolations. And the reason we did this is, all of these kinds of advance estimates are based on a certain understanding of seasonality factors.
Dr. Sen, just 1 minute,
now,
sir.
Dr. Sen, factors work.
Dr. Sen, may I interrupt you? I'm very sorry. I want to interrupt you only because some more numbers have started coming in, and I could read them out to you, so you can tell us how valid these, how seriously we should take these numbers. Like Ekta told you, 6.1 is the expected GVA for the full year, and the GDP is estimated to be 6.5%. Remember, these are only estimates. That's for viewers who would be wondering where this number is coming from. The private final consumption expenditure is expected to grow by 6.3%. compared to 8.7% last year. Consumption, according to the estimates, has fallen. The government final consumption expenditure has fallen seriously. And I don't know why, because at least there was a huge deficit and expenditure number in November. The government final consumption expenditure is coming in at 8.5% compared to 20.8% last year. So severe crunch in government expenditure. Gross fixed capital formation is expected to rise by 4.5%. Definitely better than the 2.4% last year. Exports remaining stable at 4.5%. Imports rising to 10%. I guess it's the strong rupee impact. So clearly strong rupee is more an import substitution impact, or so it seems, and not so much a detriment to exports. What other numbers do we have? Just give me a minute. We should be able to give you the per capita number. Per capita is expected to grow by 5.1% compared to 5.8% last year. So lower growth has also meant lower distributive impact of the growth. You have the agriculture other numbers.
No, Latha, agri, yes, it is estimated at 2.1 versus 4.9% on a year-on-year basis. So that too is expected to be lower according to them. Trade, hotels and transport, 8.7. So that's expected to be better versus 7.8%. And financial real estate also probably expected to pick up. But I just want to tell you the asking rate for the next 2 quarters more precisely. If in case the GDP is expected to come in at 6.5% for the full fiscal, then next 2 quarters should be 7%. And if in case the GVA is estimated to come in at 6.1%, then the next 2 quarters have to be 6.4% at least in terms of
that's actually a low asking rate.
7.1% figure.
Dr. Sen, just the question of how reliable are these estimates, as also what do you make of this, much lower than expected 6.1% GVA that the CSO has put out?
Well, Latha, the 6.1 for me is actually not a surprise, because I've been talking about 6.3 GDP. What really comes as a surprise, well, first let me give you a feel for the reliability of the numbers.
Yes, sir.
So I said, these are based on seasonal adjustments. You have 2.5 quarters of data, and then you apply seasonal factors to project the rest. Now the problem is that this past 1 year has been very disruptive, and we are not even sure that the seasonal factors would play out in exactly the same way. Agriculture, yes, but for the others, no. And therefore, the question marks become even larger.
Absolutely.
So having said that, the thing that really surprises me is this large gap between the GDP and the GVA estimates. You know, what it suggests is that there's been a massive improvement in the net indirect tax collections, which is indirect taxes minus subsidies. Now, we know indirect taxes have done nothing. I mean, this is data. I mean, it's come in. So unless they're expecting or projecting a massive improvement in GST collections over the next 2 quarters, I don't see how you get a 0.4 percentage point bulge.
Yeah, I agree.
That really comes to me as a surprise. I would have thought it would be 0.1, 0.2. Okay. Because now oil prices have been firming, which means that the subsidy element also will tend to go up.
Yes. Actually, in the previous numbers we got, we did see a narrowing of GVA and GDP. So this does come as a surprise. Coming to you in a minute, Dr. Sen, Ashima Goyal is also with us. Good afternoon, Ashima. The numbers come in at 6.1%. That's the GVA number, and 6.5% GDP. I thought the Reserve Bank's estimate was 6.7, so this is coming in lower than the most important official estimate available.
Yes, it shows that the Reserve Bank has been overestimating potential growth and underestimating the output gap. This has been a very disruptive year, but I think, as Dr. Sen was saying, this is based on projections given 2 quarters, and they've had to do this even earlier than usual because of the advancement of the budget date.
Yes.
Yeah, so there's even less reliable data to make the estimate. Okay. And what we are very recent data suggests that there's a lot of improvement in this last quarter. So possibly the actual estimate will be somewhat higher than this advanced estimate.
Are you referring to the PMI and truck sales and stuff like that?
Yes, I was especially, the core sector, steel, cement, that suggests some uptake in housing, low-income housing perhaps is doing better, exports, consumption, consumer durables, cars. So I think there is some, coming out of all the problems in this last quarter. And since this advanced estimate doesn't draw on all that, it might be missing it.
Okay. Well, actually, I just wanted to check back again as to what the RBI was forecasting. RBI is forecasting a GVA of 6.7%, not GDP. So this is a distance from what the RBI has forecast. That would tantamount to a serious overestimation or perhaps underestimation on the part of the CSO. We don't know.
Maybe this policy could be, we could probably see a revision in the GVA from the RBI.
We don't know. I mean, the RBI could still want to look at further data, but yes, that's perfectly possible. Upasana Bharadwaj is also with us. Upasana, your first reaction to these numbers, 6.1 GVA, 6.5 GDP, and even a per capita income number that's not very flattering, 5.1%. Your thoughts?
Yes, clearly, Latha, we were expecting the year's average at 6.5% GVA average, and obviously it's lower than that. Somewhere I believe that, like Dr. Sen has pointed out earlier as well, I mean, given that, the advanced estimates are taking into account just April to November, of which until September, any case we had the data wherein GVA was at 5.8%. Clearly, it is not capturing the recent improvement in activity. And more so, we did see a fizzling out of activity in October, but November has really been a very robust month. If you look at across the board, high frequency data. So somewhere there is a possibility of an upward revision, but of course, it may be now not to the scale of 6.5% or 6.7 as RBI is estimating. It could be probably closer to 6.4 or little, somewhere around those levels. But of course, I think at this point in time, 6.1% is definitely a a very weak or a disappointing number.
Okay. Well, Upasana, you know, since you are the person here who is working every column, I guess, on your Excel sheet, agriculture is placed at 2.1% growth compared to 4.9%. Mining at 2.9 versus 1.8 last year. Manufacturing is coming in at 4.6. It was 7.9 last year. Electricity, gas, the utilities basically is 7.5%, similar to last year. Construction is still poor, 3.6, but better than 1.7 last year. Trade, hotels, transport coming in at 8.7 compared to 7.8. Finance, real estate, professional services 7.3 compared to 5.7. And the worst performer really is public administration, defense and other services coming in at 9.4 versus 11.3. Where is your disappointment? How is it adding up to 6.1 according to you? Where have we fallen short?
No, clearly, the first element here is agriculture. We were expecting a little higher growth there. Of course, we knew that there could be a potential downside because of the weaker rabi sowing and you know, some of the output which has been quite disappointing. But apart from that, I think where we might see an upward revision is clearly manufacturing. We are seeing all indicators related to manufacturing of late in the high frequency data to be far better than what the normal seasonality has been suggesting as of now. So I think right now I would say manufacturing is the biggest, I mean the sector wherein I'm expecting an upward revision. So here is the disappointment which is most.
Upasana, you know, Dr. Sen. We still have Ashima Goyal with us. Ashima, you know, I'm going to just pose this question to you because Dr. Sen did mention about, you know, GST collections being crucial in terms of picking up for the next couple of months. Do you think that after what we saw in November, we could probably see an incremental pickup up to March? And what would you be probably anticipating on the same as well?
What was the question, sorry?
For GST collections, do you expect it to pick up in the coming months?
Growth.
Yes.
Yes, I think so. We are seeing the high frequency indicators are suggesting that. And this advanced estimate does not really capture that. It's based on the past 2 quarters which did not do well at all. But that said, I think the Reserve Bank has really you know, overestimated growth, which is
you know, well, let me tell you, the Reserve Bank and the country are not in a very enviable position. We are seeing this is the 3rd year that growth GVA is falling. 7.9% 2015-16, 6.6% 2016-17, and now 6.1% 17-18. At a time when we are going to have inflation numbers revised higher because of the global uptick in commodity inflation, and of course possibly a higher fiscal deficit also, we don't know yet. Dr. Sen, it's not a very positive comment on the macros. Growth lower than expected, inflation higher than expected?
Well, you know, it's really a part of a trend, something that I think we had been expecting for a while, that this was going to be happening. You know, the real fact is that this data still doesn't reflect what's happened to the unorganized sector. So the unorganized sector is getting reflected only to the extent it impacts the demand for the organized. That's how it appears in these figures.
Yeah.
So it's a pure demand side effect. You're not picking up the output effects. Now, in a situation like that, until we have some credible information on turnaround of the unorganized sector, I think we shouldn't expect any grand revival. Yes, the global economy, I think, is going to be a lot more benign in the coming years than it has been in the past 8 years. But that I don't think is enough. Agriculture still seems to be hurting, and hurting seriously. And I would really like to know, I'm sure they haven't given the breakup, between crop husbandry and animal husbandry. How does that play out? I mean, is it purely a rabi sowing problem, or is it a continuation of the weakening of the animal husbandry sector that we'd seen in the first 2 quarters?
Okay. Well, no, I'm not sure I'll be able to give you that number immediately. But Ashima, so you know, I just wanted to place exactly the data you're saying. Core sector data did show, you know, 17% growth in cement, of course, from a terrible base year ago. as well good steel output. Even month-on-month, cement and steel looked very good. Truck sales were excellent for the month of December. And of course, PMI came in at a 5-year high, 54.7. So how much do you think this 6.1 may actually turn out to be? Will it not be as bad as 6.1, maybe 6.3, 6.4?
Yes, I think not more than 6.4, because, for example, the Reserve Bank had for its 6.7, you need 7.8 in the last quarter. That is extremely unlikely. So I don't think we will cross 6.4. But what is positive is that given the disruptions, there is a turnaround. It suggests that the very recent high-frequency data, although the advanced estimate does not suggest it. And I think there is another worry for the budget, because they had estimated about 11.75% nominal growth in the ratios they had calculated. And we're going to fall short of that.
Oh,
yeah?
yes.
So that is going to be also affect the ratios.
Oh, okay,
yeah?
okay. Yes, yes.
Okay.
There is that as well. I agree with you. But Dr. Sen, you know, exactly this point that Upasana and Ashima are raising, the post-November data, November itself, core sector was good. My sense is the CSO would have taken that into cognizance, because they announced the numbers, and these are November 30th numbers. The initial note itself says that we have taken numbers up to November. You know, the December truck sales were excellent. The December PMI was excellent. So would you agree with Ashima that there is a chance of an upward revision?
No, I think things are looking up. Now, the real question is how much of it have they taken into account? I mean, you know, we are assuming that they haven't. I'm not sure that that's correct. So it's a little difficult to predict.
Okay. Okay, I'll take your point on that. Gross fixed capital formation, Upasana, coming in at 4.5% compared to 2.4 last year. Is that a ray of hope?
Yes, I think on the gross fixed capital formation, I mean, if we look at the quarterly numbers, the last 2 quarters numbers were also quite promising. We have been seeing a gradual improvement in the GFCF, and I think that is likely to, you know, continue as we go forward. You know, if the rural and the urban consumption kind of remains stable with a slight improvement as we go forward, then I think the slack in the system is going to gradually reduce, and we should start seeing a revival in the private capex. So somewhere I think it's in the making, and gradually though, but we will start seeing the GSCF numbers start becoming more and more promising.
You also agree with Ashima, I guess, that the ultimate number may not be 6.1, maybe better?
Yes, absolutely. So like I said, I think as we go forward, we should see at least the economic activity indicators are already, lead indicators are suggesting good data, and we should see some more recovery as we go ahead. So the last quarter GDP numbers is in any case expected to bounce back because of a favorable base effect. And along with that, on a sequential basis also, if the improvement continues, then we expect some kind of a revision on the upside. Yeah.
Okay. Dr. Sen, you know, I just want to probably ask you to crystal ball gaze a little bit. My sense, I mean, the sense is that FY18 is anyway a transition year because of the implementation of GST and the after effects of demonetization. So what's your sense in FY19? How much of a scale up do you expect as compared to, say, the CSO estimates of FY18?
Quite significantly, I'd imagine. You know, I would still be a little hesitant to get carried away, but I think something around a 7% figure is certainly within reach.
For the next year, you mean?
For FY19.
Okay, okay. So even then, that sounds modest, sir. I thought the IMF or other such organizations were going with 7.4 and numbers like that, because this year is expected to be subdued due to a double disruption.
You need to be a little careful on that, Latha. Latha, you need to be a bit careful on that, because the IMF reports it in terms of dollar growth, not in terms of real GDP in the sense we understand it. And with the rupee appreciating, it pushes the growth rate up quite significantly.
I agree, sir. So actually, that thought occurred to me. You know, the per capita GDP, according to current numbers, not real numbers, is actually now standing at a tall 1,25,000 rupees, which means if the rupee were to move even to 62.5, bingo, we are a $2,000 per capita. Sounds good, at least that. I mean,
right.
maybe it's just feeling pleasant. But we are a $2,000 per capita.
IMF picks up.
Sorry, sir?
Yep.
Well,
I think that's what the IMF picks up.
okay, yeah, I mean, that at least sounds very good. I mean, we were sub $1,000 for the longest time, but the jump from, say, $600, $800 to $2,000 has happened, I would assume, in record time. I think, what is it, 6-7 years that we have managed to double the per capita GDP?
Yeah, almost.
Okay. Upasana, is there any other comment? I mean, per capita income, imports growing by 10.2%. Would you visit that on the rupee? That's the sharpest growth actually from the demand side.
Yes, I think import growth, so I think it's going to, pick up further, right, as we go ahead. We're not really expecting that to really moderate, so I don't see any respite really coming from on the net demand or net external demand to the overall GDP. I think that is likely to remain a drag. But I think given that the external demand overall, global demand is robust, and as we are witnessing that export growth across emerging economies has been quite good, probably, India's exports will also now trend higher, the growth, and that could provide some kind of respite when it comes to the net external demand. But overall, I think if you look at the growth, non-oil, non-gold, also the core demand side, we are witnessing an uptrend there. So I don't think we'll see any respite from the import growth side, really.
Okay.
But I think just one more comment.
Sure.
Regarding the GST collections, when we're talking about the trade hotels components, the way we are calculating that is based on the sales data, sales tax data, sorry. Yeah. And, that is where I think somewhere when we're getting our next round of quarterly estimates in February, we'll have to see, remain watchful how the collections, the GST collections now will be really translating into the numbers. So probably there could be a possibility that the H1 data in itself gets revised up slightly, and hence we see an overall revision for the in terms of annual numbers as well.
Actually, that was those fundamental questions that I was going to raise to Dr. Sen before the numbers hit. I mean, the CSO estimates are always preceded by this paragraph that we have extrapolated this from the first advance estimate of crop production, IIP for the first 7 months of the year, financial performance of listed companies, and then you have that, sales tax, etc., etc. Now, those numbers are in so much disarray that, would you say, Dr. Sen, this year in particular, the estimate is particularly fraught with problems?
No, it is. So, the gorilla in the room is really the trade sector. So sales tax was used essentially to estimate the value added in the trade sector, and that's the single largest service sector in the economy. Now, the sales tax data is no longer there. Since July, you don't have any sales tax data. So I suspect what they've done is they've gone back to the old methodology, which is, prior to getting the sales tax information, which is use the overall turnover of the production sectors, which is agriculture plus manufacturing, and use a ratio on that to calculate the. So I think they've gone back to an old system, and so there may be some bit of a lack of comparability between, let's say, the first quarter of this year and the numbers we are seeing now.
Okay. Well, actually, the entire CSO team is about to speak. So, two last final questions to both of you. Dr. Sen, where does this leave the RBI? No scope for a hike anytime soon? Extended pause?
There is no reason for a hike, and I would, if I were RBI, I would just sit tight.
Okay. No, sir, the inflation number that we will get for March may well be very close to 5.5. I mean, there is base, and then there is all these crude prices and other global metal commodity prices. So we may optically be very.
This is true.
Yeah.